everyone. Welcome to Baird's IPO Reboot. I'm Tom Schadewald. I'm a director on Baird's Equity Capital Markets desk. We're releasing the Reboot program this year as a place for executives to learn the ABCs of going public on their own time through this 12-part video series. Today's episode is episode number 3. It's on pre-IPO activities, the do's and the don'ts. I'm delighted today to be joined by two of our go-to legal experts at Latham Watkins, Chris Lueking and Scott Westhoff. Chris, Scott, thanks for joining, and I'll pass it over to you guys to introduce yourselves and give a little bit of background about your practice.
Sure. Hi, I'm Scott Westhoff. I'm a capital markets partner at Latham Watkins in our Chicago office. I've been here my entire career and largely focus on equity capital markets and mainly within that IPOs and occasional follow-on offerings and SPAC transactions, largely in consumer retail, tech. Chris and I do a lot of biotech and pharma work together, and then I was doing some crypto, not so much anymore, but those were my typical areas of focus.
And I'm Chris Lueking, and everything that Scott said about himself is true of me. Exactly the same thing. I'm also a corporate lawyer at Latham for my whole career, and with a focus on capital markets, particularly equity capital markets. Like Scott, my favorite project to work on is representing a company in the IPO process, which we do a lot of. And as Scott said, as lawyers, we're generalists as far as business area. So we work for companies in lots of different businesses, which makes it fun. So thanks, Tom.
Yeah, thanks for joining. And so we're going to do a little bit of a moderated panel. I'll play moderator here. And so maybe one of the natural starting points, just practical advice that executives should think about and be aware of is around kind of permitted communications. I think some people hear the term gun jumping. Chris, maybe would you mind talking a little bit about kind of what you should and shouldn't do leading up to an IPO process as it relates to kind of internal and external communications?
Sure. So the notion of gun jumping is the SEC taking the view that outward communications from an IPO company at the beginning, at the ORD meeting, and then after that, when the company is deemed to be, quote, in registration, that those communications can actually amount to illegal offers of the company's securities because they're meant to condition the market for the IPO. The SEC construes the term offer very broadly. And so companies need, as soon as they begin the IPO process, which may be many months before the IPO actually takes place, to pay attention to communications by the company that are outward that can run afoul of this. And definitely you can expect that the SEC, once you're on file, is going to be monitoring what you say. They're going to be reviewing everything said about you. And so you need to pay special attention to your communications so that you don't run afoul of this issue. The concern primarily is information about the company that's rosy and that would be of interest to equity investors. So information about future growth, prospects, forecasts, other kinds of financial information. Those are the things to be particularly worried about once you begin your IPO process. A couple of additional legal points in this area. There are several safe harbors that protect companies in this process. One is any communication that is made by the company more than 30 days before the first public filing of the registration statement has an exemption from being deemed to be an offer. And it's Rule 163A. It's what we often look to and rely on if we trip up in this area earlier in the process. The second safe harbor is under Rule 169, which is a provision that says if you are making not forward looking, but backward looking historical, factual information about your company that's geared not toward investors, but toward business partners, customers, and it's factual information consistent with the way you've made announcements about your business in the past. That's also something that's okay. Um, so anyway, a couple of rules of the road for companies to keep in mind on gun jumping generally, given what I've said. One is once you begin the IPO process, you need to monitor all of your communications from the company, and typically that means that your lawyers and even the underwriters council will need to review your press releases to make sure that you don't run afoul of these gun jumping concerns. Secondly, focus on your communications being geared toward factual disclosures, not relevant to investors, but rather to business partners and customers. Third, probably the biggest risk in this area is when there is some uh, publicity about your company actually pursuing an IPO. So you should have a strict no comment policy for people if they're asked about whether the company is pursuing an IPO. And by the way, that happens in almost every deal where there'll be some leak of the IPO process and the media will call somebody at the company and ask about that. You want to make sure that people know to say, we don't comment on these matters. And finally, it's a good idea to keep the number of people within your company that even know about the IPO process as limited as possible, just to reduce the risk of communication about this leaving the company and creating issues for you in this area. Did I get that right? Is
You
there
did.
anything else?
You did.
No, that was
It's a,
thorough. As I say, one quick follow up, maybe a question we're getting. Some companies that were thinking about going public, let's say a year ago, they're getting invited to kind of industry conferences and things like that. Anything they should know about? Can they participate in things like that?
Yeah, that's a great question. Typically, when you are in the IPO process and you're actually moving forward and it's happening real time, our advice to clients is to be very careful about even choosing to participate in an industry conference because there are all these potential investors there. You're going to be asked a lot of questions, a lot of questions about how your business is doing, and all of this falls into an area of concern for gun jumping. If your IPO is on hold, as is the case for so many people, we think uh, we can have more flexibility and allow companies to participate in conferences. It's more important than ever that they're known. And so, we advise that it's okay to participate in conferences, but you need to be coached by your lawyers to be careful about what you say so that, things you're not quoted in a problematic way down the road.
Yeah, no, that's great advice, Chris. Maybe Scott, I'll turn it over to you with kind of the next topic here. You speak to kind of any special considerations that executives should be cognizant of if they're doing a pre-IPO capital raise or they're issuing employee options leading up to the IPO?
Sure. And so the first part about a capital raise is what we look at as typically a crossover style investment, which you'll see has really become popular in capital hungry industries such as healthcare, biotech, tech, where there's a lot of growth. They need a lot of capital to run the business. They burn through it rather quickly. The crossover investment during the IPO process to fund the business has become a pretty commonplace way to gain a little bit of extra capital. Some of the issues there are the one, you want to look at valuation. You want to make sure that you've got a what we'd call a bona fide valuation that's not going to come in if we're doing an IPO a few months later. You see we're valuing the company at some giant multiple over the crossover. there may be some questions that people are asking about how you came to this crossover valuation and what the thought process was there. The other, what we talk to a lot in these situations is what sort of information are you giving the crossover investors to enable them to evaluate the company? Because almost every time these crossover investors also are going to want to participate in the IPO, be able to get an allocation and purchase in the IPO as well. That takes us to this push-pull between giving them certain projections that you wouldn't put in an IPO prospectus for liability reasons, and certain other what we'd call material non-public information that won't be cleansed in your IPO prospectus. The crossover investors, some may say we don't want any, and some will say they need it. So you start to have these discussions about cooling off periods. How much time do you need between closing out a crossover round that included some projection information and launching your IPO, and whether or not these investors can participate? Uh, you see the market vary on that a fair amount. You've seen in tech, for instance, and in biotech, where projections go stale rather quickly because the landscape is changing. The projections typically after a turn of a quarter or so, those things get pretty stale because you see a lot of difference in their financials and in their prospects in general. We have seen the market get comfortable sometimes with a 1 quarter turn of being a sufficient cooling off period. There's a little bit of discussion about also the fact that if we're giving these crossover investors information that we also give analysts during our analyst day for the IPO, and that information is through secondhand built into the analyst model and therefore filtered out to the public, there's a way to get a little bit more comfortable there than if you were giving crossover investors additional information, call it extra years that you don't give the analysts. That becomes problematic. But we typically are seeing the market get comfortable as long as you have the proper guardrails, with a 3 to 6 months being the cooling off period. Beyond 6 months seems to be a little conservative at this point. But definitely, I think the punchline there is that investors that need capital can certainly go out and do so during the IPO process and work with the underwriter counsel and the company counsel just to make sure that we're doing it properly and we have the proper guardrails to not box anyone out of the IPO and make sure that we don't have any gun jumping issues and the like that Chris had mentioned. Second prong, or actually go ahead, Tom, if you have a follow up there.
Does it say, like, is it the investor who decides whether they have material non-public information? Do they make a determination for themselves, or who ultimately makes that determination?
So a little bit of both. So an investor can make that decision vis-a-vis their compliance department and whether or not they think it's okay to participate in the IPO. However, the underwriters will also take a crack at that same decision. And if an underwriter, for instance, decides, look, we think they have MNPI, we can't give them an allocation. So there's two parties to that.
Okay.
There's two parties to that, which creates this. You've got to get on the same page during the process with your underwriters before you go out and just raise crossover capital. Because the underwriters may look at it through their compliance lens and say, I can't give this fund an allocation now because we're not comfortable with either what you gave them or the cooling off period is too short.
Great.
And then the second prong on equity grants pre-IPO. So this is what we start to, you hear the term cheap stock thrown around a fair amount. Where you have issues here is if we grant equity 3, 6, 12 months before the IPO, and the strike price on those equity instruments tends to be materially lower than the IPO valuation or the per share price in the IPO. The SEC can start to look into that and ask questions. Where did you get the valuation? What's driving the difference? And if the difference is too large, it can give rise to additional compensation expense that's going to be saddled to the company when you're asked to true up that value, which can materially drop your net income. It's a non-cash charge, but it can drop net income, and it can ultimately become a marketing issue for your underwriters who thought they were marketing a company with net income of X, which would translate down to EBITDA of Y, and now you've got X minus, and trying to figure out how that implicates or impacts investor interest in book building.
Yeah, no, that's very helpful, Scott. Maybe Chris, turning it back over to you. Obviously, M&A is kind of an ongoing part of most executives' day-to-day business as they look to grow. Are there any foreseeable complications that they should keep in mind when it comes to kind of pre-IPO mergers and how that may impact the IPO process?
Yeah, that's a very relevant consideration for many companies that are pursuing an IPO. And there are sort of two categories to focus on in this area. One is what acquisitions or dispositions have occurred and are completed, and what we do is we run significance tests with the involvement of the accountants to test the significance level of the acquired business vis-a-vis the issuer, and if it exceeds a certain percentage level, there is a requirement that historical audited financial statements for that acquired business be included in our IPO registration statement, which can greatly add to the financial statement disclosures in our prospectus. Along with those, if the completed acquisition is significant enough, our pro forma financials showing what our business would have looked like financially had that acquisition occurred at the beginning of the relevant period. So it's super important right at the outset to understand what material acquisitions may have already been completed. Uh, and those tests can be not necessarily intuitive, and so it's important to look at those significant tests right away and be sure to get the accountants involved in figuring out whether we're going to have these kinds of financial statement requirements in our disclosure, which of course then you're dealing with consents from a different accounting firm, auditing firm, comfort letters that the underwriters will require from that auditing firm relating to those financial statements, which can be gating issues for the IPO. The second category of M&A activity to focus on and think about is what's currently pending, what's being discussed, what is the company hoping to pursue but has not yet completed. And I would say that typically, once you get at least down the road in an IPO process, where your plan is to try to market the IPO in the fairly near term, that companies then would typically slow down an acquisition process, because you don't want to be in a situation where you're suddenly at the last minute uh, signing up a deal so that it becomes probable, which is a relevant term for when financial statements are required in your registration statement. And then, you create all of these additional disclosure issues. So you need to very carefully monitor your and really make a decision about whether you slow down your acquisition process to accommodate your IPO. The other thing I'll say is that you also want to avoid a situation where you slow down an acquisition, you do your IPO, and then very shortly after the IPO, you're suddenly having a material acquisition that you've signed has become probable that you need to disclose, and then the concern is, well, did you have an omission in your disclosure at the time of your IPO? You didn't tell investors that this acquisition was close to occurring. There's not an absolute science about how that timing should work, but you do need to focus on that to make sure that there is a sufficient amount of time after the IPO occurs before any material announcement is made in this area.
So is a bright line kind of when you'd sign like a letter of intent, or would you even be email traffic kind of discussing valuation, or kind of where is there a kind of practical like limitation people should think about in their minds?
Yeah, there's not necessarily a bright line that applies to every situation. And what you're talking about here, Tom, is when does a potential acquisition become probable such that disclosure about it needs to be made? And as I said earlier, the notion of a probable acquisition over a 50% significance level then creates an obligation to actually include the financial statements for the acquired business that we're talking about. Um, I think the SEC has taken the position that signing a letter of intent can certainly make something probable, and certainly signing up an actual purchase agreement
Yeah.
would make something probable. It may not always be the case that an LOI, if there are all kinds of outs, would make something probable, but it's definitely something that you need to focus on and include the underwriters and their lawyers in that discussion.
So I think you're hearing it a lot here, but when you start down the IPO path, you should just communication kind of across the entire working group becomes critical to kind of keep the ships or the trains running on time. So
Yeah, there's nothing we can't solve for if we know about it. And
yeah,
unfortunately there are enough stories and times where something comes up that none of us knew about, whether it's the underwriters or both sets of counsel or whomever, until it's pretty far down the road. If we know about things, we can certainly solve for them, fix them, make sure that the process keeps going. If we don't know, sometimes it comes too late, and then we're stuck with some tough choices.
yeah, no, that's a great point, Scott. And so maybe I'll keep the baton with you here as related party issues. That's something that you hear a lot of people talking about when they're talking about going public. What are some of the most common ones that management teams are typically trying to address and solve for, and how best could they attack those to kind of set them up for kind of a smooth IPO process?
Sure. So there's a lot of flavors of related party transactions that may be going on before while a company is still private. All of which, as we know, within a 3-year period of the IPO, need to be disclosed properly in our IPO prospectus. Some of these things that are quite common that you try to deal with and either terminate or get your arms around pre-IPO. The first being, and not super common, but it'll come up enough that we mention it, is loans to directors and officers from the company, which used to be some pretty common, are prohibited under Sarbanes-Oxley. So those things need to be fully paid back and off the company's books before you go public. Public companies cannot be lending money to the directors and officers under Sarbanes-Oxley. So that's one to look at. It's not super common anymore, but I have run into it once or twice, and it's can be a little tricky if the cash isn't there to take those out. Because sometimes if you've got a founder who's all of their net worth has been propped up into this company, occasionally they need money, they'll get a loan from the company, and then they start to wonder, or they start to discover that that's a problem when they want to be public. That's the first category. I think the next, and you run into these mainly with companies with sponsors and occasionally companies with founding families or venture equity, are shareholders agreements and other management services agreements that are in place. Those sorts of things you want to get with your lawyers early to find out, first of all, what's all required in those. What are the termination provisions? Do they have anything in them that is not is a little untenable for a public company that we need to amend to work out? And then you also need to understand that the amount in question needs to be disclosed. So you'll do a lot of cleanup of those agreements. In particular, you'll want to, if there's any governance rights in those agreements, for instance, your sponsor has the right to nominate your entire board or half of your board or some amount, or you've given up board rights to other early stage investors. Questions there are: do we want to keep those? Do we need to get rid of them? Do we need to amend them in some way? And not all of your pre-IPO investors are going to be amenable to just dropping those rights just so that you can become a public company. All things we can work with, but it's helpful to know early, diligence early, and work also with the underwriters on how we market those things when the company is going to be saddled with them going forward. Same with early preferred investment documents, which are typically often become related party transactions because those financing sources own over a certain threshold, or they've got a board representation. How do we deal with the conversion of that equity? How do we deal with those terms and what survives an IPO and what doesn't? Some registration rights agreements are also quite common that you want to get wrapped up or revised or entered into pre-IPO. That will give your pre-IPO investors whose all their preferred converts to common in an IPO, not registered, so they can't sell it on the open market. They'll have the right to require the company at the company's expense to register those on a registration statement at some point in the future to allow them to get liquidity at some point. So those are your typical flavors: loans to directors, management agreements, shareholder voting agreements, and things like registration rights. Anything that I'm leaving out there?
Very comprehensive.
Thank you, Chris. So, like, as a company thinks about going public, obviously there's a lot more internal functions that kind of need to be developed. Are there any kind of incremental hiring needs that companies should think about more specifically prior to going public? And when do they typically kind of try to get those in place?
So yes, the answer is yes. We'll talk about a couple of categories that are relevant. First of all, your senior executive officers you want to have in place and not changing at the time of the IPO. Obviously, the CEO, CFO has a very important role in the IPO process. Typically, those two individuals will be involved in the roadshow and marketing the company to IPO investors. So you don't want to have a situation where you have a change in one of those very senior positions shortly after the IPO. And it's not just the CEO and CFO, but also other senior executives, operating people. You want to have that group of senior management in place by the time you're marketing the IPO. Other categories that are relevant often need building up for companies that are going to become public is certainly your finance and accounting, internal audit personnel. You'll need to have people staffed that can allow the company to meet its timely financial reporting obligations as a public company, which obviously you can't miss on. So it's very common that companies, when they're in this process, will need to add staff for that function. Also, a good IR person or personnel, because as a public company, of course, you're going to be interacting with analysts and investors regularly, and it's super important to have somebody in that role that understands the legal limitations of how those communications take place and knows how to navigate earnings announcements and those kinds of things as a public company. So an IR person is also important. A good general counsel, of course, is important as well.
Yeah, no, those are all great points. And maybe to wrap it up for us here, Scott, Chris, feel free to chime in if you have any other good nuggets for the listeners. Are there any other just practical considerations that folks should be thinking about in advance of going public that may otherwise slip your mind?
Yeah, and I think what Chris mentioned, one of them, but the finance staff, even below a CFO, is incredibly important to get a controller, for instance, with public company experience. Most IPO companies do not have enough infrastructure necessarily to have proper segregation of duties and the like, and you don't think about it until your auditors do their PCAOB audit uplift and say you've got a bunch of material weaknesses because you don't have these things. So putting together that staff in advance is important to be ready to operate as a public company and tend to start preparing for SOX compliance. You can't ever start that early enough necessarily if you think you're going public. So engaging those people and consultants to work through that early is better than waiting until a few months post IPO and when the clock is running.
I would say that what strikes me in as an issue for so many companies that is, to me, probably the most important thing is when you become public, you need to have some predictability in your results of operations. You need to have a financial model put together where you can forecast what your results are going to be. You need to have that done and shared with the analysts at the investment banks that are taking you public ahead of time. And there will be expectations then by the street of how your company's going to do. So if you're pursuing an IPO, you need to have good visibility into your future results, at least in the the year or so after the IPO, and the ability to model all of that out. Hugely important
Yeah.
for any IPO company.
Yeah, agree. One of the other things I think this is more relevant to smaller companies that don't have a ton of cash. Typically, think pharma, think tech, who are very cash strapped coming up, and most of their cash is going directly into reinvestment or payroll or running the business, where they don't have a lot of money to be paying a big four auditor to audit their private financials. It's important to evaluate who your auditor is before you engage in this IPO process. There are many investment bank who will not underwrite a deal that does not have a big four, or call it a big 6 or 7 if you look down the list. We've run into some issues there where a company is convinced an underwriter to move forward with a very small auditor. Issues start to arise as we move forward, and processes can grind to a halt because you're looking at now re-auditing with another auditor because of whatever issues have just become insurmountable. So evaluating those things and understanding that it's going to cost you have to put some investment into what you're spending in your outside auditors as well. Another one we run into often that doesn't come up until we start doing due diligence and the process has started. Underwriters counsel will almost always ask, what's your anti-money laundering policy? What's your OFAC policy? What's your anti-corruption policy? How do you handle data privacy? Which has become a hugely important piece for pretty much every industry, especially if you have dealings in California, if you have dealings in Europe at all with GDPR. And so many times we hear, we don't have anything, or we don't track that, or we're not sure if any of our goods are coming from a sanctioned country. To have some idea of how your data is being used, how you're protecting it, how you're complying with relevant jurisdictions is extremely important. The liability that you're saddled with really as a private company, but you're off the radar. But once you're a public company on these things is becoming it's fraught with risk. And to be in a spot where you don't have any infrastructure for that, 6 months out of an IPO is a tough spot to be in. You'll really start scrambling to protect yourself, and it's better to think about that sooner rather than later. That often falls through the cracks, and it's becoming every year it becomes more and more important.
Yeah, no, those are great points. I mean, one of the other ones I've run across too is just from a marketing perspective. It's a good chance to just do a revamp of the old website. Maybe take a look at your color scheme and see if you can freshen that up a little bit too. But it's all the small things, and I think as part of the IPO process, it's just a good opportunity to kind of make that next step into being a public company, and just kind of fine tuning the story. So I really appreciate, and I'm sure the listeners do, both your times, Chris and Scott. This is the Baird IPO Reboot. If you have any questions for any of the three of us, please feel free to reach out. Our contact information is on our respective websites. And if you've made it this far, I'll give you the teaser. The next episode up is drafting the offering documents. And so with that, we'll sign off for today. Chris, Scott, thank you very much.
Thanks, Tom.
Thanks, Tom.